A credit card is a thin, rectangular piece of plastic or metal issued by a bank or financial service company that allows card holders to borrow funds with which to pay for goods or services with merchants that accept cards for payments. Credit cards impose the condition that cardholders pay back the borrowed money plus any applicable interest as well as any additional agreed upon charges, either in full by paying the billing date or over time. In addition to the standard credit line, credit card issuers may also grant separate cash on a line of credit to cardholders, enabling them to borrow money in the form of cash advances that can be accessed through bank tellers, ATMs, or credit card convenience checks. Such cash advances typically have different terms, such as no grace period and higher interest rates, compared to those with transactions that access the main credit line. Issuers customarily preset borrowing limits based on individuals' credit rating. A vast majority of businesses let the customer make purchases with the credit card, which remains one of today's most popular payment methodologies for buying customers' goods and services. Now for understanding credit cards. Credit cards typically charge a higher annual percentage rate versus other forms of consumer loans. Interest charges on any unpaid balances charged to the card are typically imposed approximately 1 month after the purchase is made, unless previous unpaid balances have been carried forward from a previous month, in which the case that there is no grace period granted for new charges. By law, credit card issuers must offer a grace period of at least 21 days before interest on the purchases can begin to accrue. That's why paying off balances before the grace period expires is a good practice when possible. It is also important to understand whether your issuer accrues interest daily or monthly, as the former translates into higher interest rate charges for the long as the balance is not paid. This is especially important to know if you are looking to transfer your credit card balances to a card with a lower interest rate. Mistakenly, switching from a monthly accrual card to a daily one may potentially nullify the savings from a lower rate. Now to go through the types of credit cards. Most major credit cards, which include Visa, MasterCard, Discover, and American Express, are issued by banks, credit unions, or other financial institutions. Many credit cards attract customers by offering incentives such as airline miles, hotel room rentals, gift certificates to major retailers, and cash back on purchases. These types of credit cards are generally referred to as reward credit cards. To generate customer loyalty, many national retailers issue branded versions of credit cards with the store's name on the face of the card. Although it's typically easier for consumers to qualify for the store credit card than for major credit cards, store cards may be only used to make purchases from the issuing retailers, which may offer cardholders perks such as special discounts, promotional notices, or special sales. Some large retailers also offer co-branded major Visa or MasterCard credit cards that can be used anywhere, not just in retail stores. Secured credit cards are a type of credit card where the cardholder secures the card with a security deposit. Such card offers limited lines of credit that are equal in value to the security deposit, which are often refunded after cardholders demonstrate repeated and responsible card usage over time. These cards are frequently sought by individuals with limited or poor credit histories. Similar to secure card, a prepaid debit card is a type of secure payment card where the available funds match the money that someone already has parked in a linked bank account. By contrast, unsecured credit cards do not require security deposits or collateral. These cards tend to offer higher lines of credit and lower interest rates versus secure cards. Repayments. Credit cards require you to make repayments each month while there is an amount owing. You can choose to make the minimum payment as shown on your statement or pay the balance in full. You can also pay off any amount in between. Keep in mind that the more you pay off, the less interest you pay. Balance transfers and cash advances. A balance transfer allows you to transfer a balance from an existing card, say with another credit card provider or store card, onto a new credit card. With a new card, you typically be offered an introductory period with a low initial interest rate, which can help you save interest. When the introductory rate finishes, the outstanding balance, including any related interest, will be treated as a cash advance and the charged interest at the cash advance interest rates. You can also withdraw money from some credit cards. This is known as a cash advance. Bear in mind that you'll be charged a fee for cash advances, as well as higher interest on the cash advance amount you withdraw. Building credit history with credit cards. When used responsibly, regular, non-secured, and secured cards can help consumers build a positive credit history while providing a way to make online purchases and eliminate the need to carry cash. Since both types of credit cards report payments and purchasing activities to the major credit agencies, cardholders who use card responsibly can build strong credit scores and potentially extend their lines of credit, and, in the case of secured cards, potentially upgrade to a regular credit card. Building good credit history is a combination of things: making regular, on-time payments, avoiding late payments, keeping credit utilization under your credit limit, and maintaining a low debt-to-income ratio. By making responsible purchases and paying them off in a timely manner, a credit score will rise, making a customer more attractive to other lenders. How do I get a credit card if I don't have any credit? Building credit history can be a bit of a catch-22. If you don't have any credit, merchants or banks are less likely to extend credit to you since you're an unproven borrower. Opening a secured credit card is one of the simplest ways to get started. Since spenders are only borrowing from the money that they put down as a deposit, there is little risk for lenders and gives them a snapshot of your spending and repayment habits. Another way to start building credit is to become an authorized user on an established credit account, such as a parent or spouse. The cardholder's credit history will appear on your account, adding longevity to your credit report, but be sure that the person with who you partner with has good credit habits. If their financial choices are poor, that will also reflect on you. Do credit cards have fixed or variable annual percentage rates? Many credit cards will have both types of annual percentage rates. To find out which kind of annual percentage rate you have, read the cardholder agreement that comes with your credit card. Card issuers must legally disclose what type of APR they have and what it is. A fixed APR changes, they must also alert consumers of that. Some credit cards have fixed APRs for purchases, but variable APRs for cash advances or late payments. Read the fine print to make sure. What is a credit card annual fee? The annual fee on a credit card is the fee charged by a card issuer to extend the credit card to you. Some cards don't charge an annual fee, but others, most often cards that have reward or incentives like cashback, can charge annual fees ranging from $50 to $700. Hopefully this video has helped you inform you more on credit cards and how they work. Leave your thoughts on credit cards in the comments, and if you personally have one, and if you enjoyed this video, leave a like or subscribe for more business and finance related content.